You may use the chat box at any time during the session to submit a question. I am recording the session and planning to post it online in the event you would like to view it or share it with somebody else. And we know that people with written goals are significantly more successful than people without. I want to encourage you to jot some goals about how you can use this information down during the session. So if there's no question at this time, let's dive into today's session, budgeting. Unless.
Okay, Iris. Do I have control on that now?
Are you
okay?
Yeah.
Yeah, so we're good. We got the goals set, and as Iris mentioned, you know, the people with written goals it's been decided or kind of studied that they're 30 times more successful than those that do not have any written or goals in general. So today we'll be talking about budgeting, farm budgeting in general. And first off, again, my name is Les Humple and I work with UT Extension, and I'm based in Murray County, Tennessee, which is just south of Nashville, and I cover a 10-county area, so south of Nashville and all the way down to the Alabama line. And you know, within the job that I do, I work with producers on all scale sizes. And we do have the large grain producers, cattle farmers, dairy farms, as well as smaller producers who are just starting out. Some of them can be as simple as just a few acres with a few head of goats, or someone that wants to start an orchard or an agritourism business. So we work with all type of producers. And so
Les, I'm just going to pause you real quick. So we can see the next slide and the notes right now. Can you just do the same thing you did before and end that?
I'm not sure what I did before, Iris.
So we can't see the full screen of what you shared right now. Maybe just click on the full presentation mode or something.
Okay, we'll see what we can do here.
Maybe display settings right there.
Is that making a difference?
No, it hasn't.
Okay. Is that making a difference at all?
No, it does not.
Okay.
I think that's the button you clicked on before. Go back to that screen looking thing.
Yeah.
Yes. Try that.
Does that make a difference?
No, it hasn't changed.
Okay. Okay, I'm not sure what's...
Can you just end your slideshow and display it one more time? It's down at the right corner side. Wait, what did you do? Just end it one more time. Sorry about this, everybody.
Okay, so we'll end it. Okay.
Yes. So go down to your right corner at the bottom, and you can see probably a display button on somewhere. I can't see. There you go.
Okay.
Huh. I can still see the slide. Well, let's just go with this. And let's
on Zoom, you'd actually have to share out the other screen of the other monitor. But that's how you know when you're sharing content now. You have to share out the
Okay, so is it working now?
No, it does not. All right. We'll just go with this.
Okay.
Sorry about that, Les.
Yeah. Yeah, so we'll be talking about budgeting in general. And first off, I just want to thank some of our references that I use. It would be University of Wisconsin, Texas A&M, got University of Tennessee, Penn State, Iowa State, Kansas State, University of Minnesota. So in general, budgeting on most farms, it's a decision that's made every day. Some of the consequences of making the decisions are kind of minimal in their short-term effect, and others can be much more substantial as far as if you're thinking about purchasing equipment or acquiring more land. Those decisions will have a long-term effect on any business, including farms. So, those decisions that are made today not only affect short-term but also long-term success of any operation. What we'll cover, we'll talk about enterprise budgets. They're really the foundation of any good farm operation. And we'll illustrate a few things about the enterprise budgets and how to construct them and also how to utilize them as well as toward the end we'll discuss some partial budgeting as well. So to start off, an enterprise is a specific product produced on an operation. That can be summed up as if you produce wheat, corn, calves, if you have an orchard or agritourism, those can all be enterprises, but we break them down individually. So most farms are going to consist of a multiple. So if you look at a normal beef farm or cow-calf operation, you'll have your cow-calf operation. You'll also have, you probably raise hay. That'd be another enterprise. And then pastures themselves are also an enterprise that you can think about. So, having the data, understanding the costs that are involved in the input and also the revenue is important. But analyzing that information is something that I think a lot of producers kind of forget about. There's so much data out there as on a farm operation that you collect. And if you're not analyzing, you're really missing out on a lot of opportunities to further benefit your farms. Not only are budgets important for far as understanding your cost and revenue, but they also aid in developing the projected cash flows, understanding what it's going to cost over the course of the year to operate your farm, and also realizing the type of revenues that be coming back in over the course of the year. So again, in enterprise budgets, it's an estimate of costs and returns associated with production of an enterprise. It's a distinct part of a farm, and it can be analyzed separately. And again, it's based on a unit. For instance, if you're on a row crop production farm, it may be 1 acre of corn and 1 acre of soybean. If you're more on that commercial vegetables, if you're raising them for, say, farmer's market, you may break that down even further into square feet. Now, on the livestock side, we kind of concentrate on per animal unit basis. So, for instance, like 1 cow, 1 hog, that type of thing. So, it estimates the cost and returns based on specific complements of machinery, land, labor, and technology. So again, in enterprise budgets, they're used, I think the best use comes out of them is really determining that break-even price and yield. It's really difficult to market a product and price a product if you do not understand what the true costs are in that product that you're realizing. I think last week Iris mentioned some record keeping as far as using Quickens and QuickBooks, and using tags and classes for those record-keeping systems. And, atomizing the receipts, breaking down, your bill maybe from the co-op or from Tractor Supply, and assigning each cost to each enterprise is critical in determining, the true value of your production. So again, it's the way to use to kind of evaluate the efficiency of the farm enterprises and the total farm in general. Another thing too is if you're thinking about starting a new enterprise, say if you wanted to start raising blueberries, and you need capital to do that, as far as visiting with Farm Service Agency or Farm Credit or a local bank, they want to know, what you have budgeted, is it going to make sense in the long term? What are going to be the costs that you're going to need, and also the revenue going forward? So that's going to be a basis for developing a good line of credit application with a precise and detailed budget. So again, with enterprise budgets, there's many out there. If you say Google a beef budget, you would want to put in maybe like university extensions to find something maybe from Washington State or Iowa State. They'll all be a little different, but they'll all operate under the same type of principle. Now, one thing to remember too, oftentimes when you look at a budget, or if you're talking with a neighbor about their costs, the revenue sources, they'll all be different. And they may all have different goals in mind. For instance, if someone has a purebred operation, those costs in genetics and breeding stock and even on the feed costs are going to be higher than you would on a normal beef operation. So again, you don't want to think in generalities as far as what the input costs are or the revenue, but you want to do your own research and develop those particular costs. One of the first steps in developing any type of enterprise or budget is really understanding what kind of resources you have available. That'll include land, equipment, labor, and capital. If you're thinking about doing a commercial row crop and you're limited on the land that you have, but you have the equipment, you're either going to have to expand that through rental, or maybe change that type of commodity that you want to raise. It all has to be done in scale. A commodity is going to return very low margins, so you need more land than you would on say on an orchard or on a vegetable production, for instance. Labor plays a big role in the type of operation you have. If it's labor intensive, around harvest time or short periods of time, you're going to have to know, is there a labor source available to you in order to finish out that production? And of course, capital. When on the farming operations, it's long term. You typically in the springtime, you're going to have to pay for fertilizer, seed, chemicals, and before you receive any revenue coming back from that operation, maybe 6, 8, 9 months down the line. So having a source of capital as far as an operating loan is critical to any type of even short-term and long-term success of a farm operation. When you look at the crop production systems, you need to kind of identify the resources available to you. Crop rotations. Are you going to have corn, then soybeans, or maybe wheat and soybeans? The timing of the operation as well. Do you have time to get your planting done in the spring? If you have a dairy operation or a beef operation, when is the calving season versus planting or harvesting? Do they conflict too much or overlap? Will you be able to devote enough time to both to make it successful? The machinery inputs used, storage of product raised is another thing to kind of think about, especially on those that participate in farmers market. If they pick their produce one day, they would need maybe coolers to kind of store that for long-term sales. If you pick it today, if you're able to cool it down, maybe you can get a week and a half out of it. So maybe attend more farmers market or have it available for more customers later on. And also process and delivering to markets. These are all type of costs that are going to be involved with putting a budget together in any type of systems, whether it's crop, livestock, or commercial vegetations. Having a checklist is very helpful, and a lot of these university budgets will have that available. There are things that we kind of forget about. We understand that you're going to have your typical input costs like fertilizer or seeds or feed for livestock, but kind of forget about those other type of costs that are associated with any farm operation, such as utilities as far as for water, electric, crop insurance, insurance on your land, or interest that may be paid. So having a good budget allows you to kind of review. Are you keeping track of all the costs that you do have? Missing some can really make a big impact on your overall profitability of a farm and decisions to make on what type of enterprise you want to pursue. On the livestock production systems, it's not much different than on the crops. You also have that planning that you have to think about as far as veterinarian expenses. Equipment needs. Maybe you can get by with less equipment on a livestock operation than you would on a row crop or on a vegetable production. But you also have to kind of keep in mind the financial needs as well, and also the time frame. When you're looking at livestock, especially on the cattle side, the money that you say invest, for instance, if you bought cattle or a heifer and you had it bred, by the time that calf is ready for sale, it'll be a year and a half down the road. So again, those financial needs are going to be stretched much further than they would on a normal, say, crop production system. So again, the purchase of an enterprise budget is to estimate the projected cost and revenue and returns of a single enterprise. And then that way you can kind of assess, are you going to make more money on corn or soybeans? And will that kind of determine which way you want it to go? Do you want to expand those acres of corn or reduce soybeans? So having those really accurate records and budgets put ahead of time will help you make those decisions. Also, it's a good planning tool that if you want to look at as far as changing up your operation, for instance, genetically modified corn typically will cost more to plant and care for versus like a conventional variety. However, on the production side, the yields should be greater on the GMO corn compared to the conventional. So by running budgets on the input costs and returns for both, you can see, it may surprise you. Maybe planting conventional corn will have a greater overall net return than, say, on the GMO or more on the traditional side. So again, budgets allow you to do those type of things. Again, we want to be consistent when we put a budget together, and that's why when we're looking at on the crop side, you want to base it down per acre, and on the livestock side per head. There's other comparisons you can made, as far as specialty crops, sweet corn, blueberries, hemp, whatever you have, but you want to be kind of consistent on the way that you compare the two. So again, an enterprise budgeting, it's that building block, one of the blocks of a farm enterprise. And as you put these all together, you have your complete farm or your whole, whole farm budget. And again, when we're looking at the enterprise budgets, you don't want to rely on someone else's numbers. You want to go through and determine your cost and revenue that you'll have in your area. If you're looking at the budgets to choose from, like I said, these university extensions across the country will have enterprise budgets, but one, for instance, in, say, Washington State on raising beef cattle, or out west in, say, Wyoming, would be quite different than it would be in the Southeast. So again, you want to be consistent as far as where you get your budgets from. I suggest using more regional, but select a budget that will be more representative of your climate that you have, especially on the growing side. Something that does well in the state of Oregon may not do well here. So again, those practices and methods should need to be consistent with your region. And also, when we look at estimating cost, it's extremely important to determine your own cost that you'll have, your own region. It can vary greatly. And one example I have here is from the University of Minnesota. Now, this data is quite old. It's from 1996. But it's making a comparison among different costs among producers for corn and soybeans. So as you look at the horizontal axis for the acres of corn, you notice under the 200-acre listing, if you look up, the costs vary from anywhere like $1.25 to $2.50 a bushel to raise that corn. And again, as you look at the red line, that's kind of the best estimate of where it should be. So if you're relying on maybe a neighbor or a friend for their numbers, it can really be a dramatic difference than what your actual costs will be. And again, similarly with soybeans, when we look at that 200-acre level of planting, the cost to produce a bushel of soybeans, of course, today it'll be higher than it was in 1996. But anyway, that ranged from anywhere around $2 up to about $4 or $5 a bushel. So again, it's critical that you do your own research, understand the practices that you're going to have and determine whether it's going to be organic or conventional, and consult with maybe a extension service or crop production specialist to determine what needs to be covered as far as costs with different chemicals or fertilization to determine your end results here. Now on the flip side, on the revenue side, it's also varies greatly. This information is from Matt Webb. He's our county extension director in Marshall County in Tennessee, and he gathered the local lamb auction prices in Columbia, Tennessee for 2018. Now this market, we usually have it twice a month in around Memorial Day, 4th of July, and I think in November around Thanksgiving, we only have one auction a month. And that's what represents those kind of voids. But as you can see, over the course of the year for 80-plus pound lambs, the price varies dramatically. In April, I think we have a high around $2.20, all the way down to a low of probably about $1.30 in mid-October. Now, even when we look at each weekly auction market, the quality of the livestock will also determine greatly the price received. If you look on May 14th, you'll see the high of the day was probably around $1.90, and the low for that same type of animal was probably around $1.50. So, understanding how the markets move, especially seasonally, for instance, with small ruminants, but also the type of livestock and the type of product that you do have will make a great difference in the revenue. So again, a lot of studies that need to be done, a lot of investigation on your part to put together a quality budget. So again, having a budget, you can modify it, change up the cost, but again, you need to make it your own. Another thing that we'll cover a little bit later, and most budgets will have assumptions about how they develop their budgets, and a lot of good information can be gathered from understanding and reading the assumptions behind the sample budgets. So in parts of the enterprise budgets, you'll have different categories. For instance, like the cost category, you'll have variable costs, which also can be referred to as operating costs. Those are going to be things that get used up over the course of the year or in growing or raising that enterprise. So it's the way to think of it, if you didn't raise that crop or livestock, you would not have variable expenses. Fixed costs, it's going to be those ownership, or it's also called overhead cost of an operation. It's going to be those costs that even if you weren't raising anything, you would still have those costs. For instance, if you own equipment or buildings, you'd have continued insurance costs, you have ownership costs, you would have interest, insurance, those type of things, and taxes that need to be covered. Now, one thing that we haven't really talked much about so far, but as far as machinery costs, those become a little bit more difficult to determine as far as how do you value those across multiple enterprises, especially when you have fixed and also variable cost. Do you just kind of lump it all together in one category? You kind of split those out. And I think, excuse me, taking the time to split those costs out across all enterprises will give you the more useful and valuable information of the net worth, so to speak, of each production system. Opportunity cost. Now, not all budgets will list those. In Tennessee, we use the term opportunity costs. And what we mean by that is most farms are going to be part-time, right? And we want to include labor that you devote to that farm. So for instance, if you have 20 hours a week that you devote to your farm, that has a value. So if you weren't working on your farm, maybe if you worked at, say, in town at Home Depot or Lowe's for $10 or $15 an hour, that would be a labor cost that we would want to put back into that budget as well. The same thing would kind of go true with owner capital. If you're investing your own money in to buy your input cost, that's a cost as well, an opportunity cost. That capital can be invested elsewhere, and those returns be coming back to you in a different way. So you want to kind of track those to really determine the true value of the enterprise that you are raising or growing, to see if it's feasible for your own operation. Now, there's a number of different budgets, and they're all a little bit different. But again, there's no specific way of doing them. This is just an example of blueberry budgets I just pulled up from different regions of the country. And if you take the time, you kind of go through and look at them, they all operate quite a little differently. And some would be more in depth than others. But what I suggest is that if you decide on one that you can really truly use and understand. If they get too complicated, they won't do you any good as far as trying to work through it and not get the information that you truly deserve or need. So again, these are just some of the key components. You have your revenue, and you have your direct cost, or variable cost, and indirect cost as well. So again, those items that get used up in the course of growing or raising would be your direct or indirect, or your direct cost. And then, of course, indirect cost would be those that be the overhead, land charges, things that you'll have to pay regardless. Budgets, they're profit projections. I mean, they're the best estimate, so to speak. So, it's not a target or a goal, but what's most likely to happen. That can be said with yields. It's important not to shoot for a goal of, say, 200 bushel an acre for corn, but rely on what's most likely to happen. Look back over the course of 3 or 5 years. What is the average? And that's what you want to kind of peg in as the amount when you're budgeting. The same thing, with revenues as far as the prices. For commodities such as corn and soybeans, there's a lot of different markets out there, and much more information than there would be on, say strawberries. So again, forecasting some of these, it becomes more difficult with some of these lesser known crops or traded commodities. So again, doing some of that history and going back and seeing and exploring other options as well. What's the price of a local farmer's market, or if there's an auction market for vegetables? What has that been over the course of the last few years, and also the course of the season? Prices change dramatically as far as in the say fruits and vegetable area. Cost and the prices vary depending on what's in season, what's not out of season. So again, reviewing those costs, getting a better understanding as far as within your own region and area of what needs to be pegged in when putting a budget together. So again, an enterprise budget, it's nothing more than revenues minus costs equal return. Like I mentioned, for commodity crops, livestock, prices are pretty well available and your outlets to sell are quite numerous compared to some of these other less known quantities. Calling around for your input cost, it's a lot of work, but it does pay off. With the internet, there's a number of farmers I work with that order a lot of their supplies online. When you think about it, if you planning ahead of what you may need, if you have to run to the vet at 8 o'clock at night to get medicine, it's going to cost you a lot more than if you order that vaccine or online ahead of time or from say a local co-op. So again, using those rates, calling around, finding what's available is critical again for that to have that accurate budgets going forward. Livestock enterprises, I won't spend too much time on here, but other than most of that is the same as it would be for crop production. You're going to have the cost as far as with machinery and facilities, but also the time period. We want to kind of review that a little bit. If you're on a beef operation, you're going to have cost over a course of the year. For instance, if you had breeding cost in 2017, that calf was born in 2018 and sold, so you do have cost over a time period greater than a year, but you do want to put those costs within that same time period and maybe condense them down into 1 year. As far as some sheep and hogs, there are times where you can have 2 litters in a year, or maybe 3 and 2. So you do want to kind of account for that and use that as a percentage as a time period of 1 year. There comes a question as far as if you raise crops to feed your livestock, for instance, say corn or hay, how do you price those into your livestock operation? Well, I look at that as an opportunity cost for both operations again, or both budgets, so to speak. If you look at corn and say it cost you $3 to produce, but you could sell it for $4 on the open market, you should be crediting your enterprise for corn for $4 and charging your livestock budget for $4 instead of that $3 of what it costs you to produce. It gives you the true value of your production. Now, in the end, when you're doing your taxes or you're putting together an income statement, those costs will be kind of adjusted themselves as far as the overall value of your farm and returns on your farm. But when you want to compare the enterprises, the best way to do it is having those opportunity costs, so to speak, over both of those budgets. The same thing, with manure, whether it's hog manure from a confinement system or poultry litter from a broiler operation. Again, finding out what the value is, you can have it tested and seeing what the true value of that fertilizer and equate that to the cost. And again, crediting that hog operation or poultry operation for the value of the fertilizer that produced. And again, you have other costs involved with hauling, whether it's the corn or hay, and also hauling away manure or chicken litter. It should be probably split between both enterprises, because you would have to haul that grain to a market anyway, or you have to haul that grain into your livestock operation to produce it. So again, splitting those costs out will give you that true picture. I mentioned earlier about assumptions for budgets, and that this is kind of what the assumptions do. It kind of tells how the budget was constructed and how it's being used. This is from the UT budget for beef or cow-calf operations, and on here it lists the assumptions that you'll see in the budget. So on the next slide here, that'll show up in a minute, you'll see how it correlates. But when you look at it, we'll have the herd data. For instance, maybe 50 cow herd with 2 breeding bulls, and we'll have the percent of a calf crop, how many calves were born, how many were sold, the call rate, as far as the cows that don't breed or that are old, that are sold, they'll have to be replaced with the heifers from that heifer crop. So it breaks it down as percentage value per animal. Same thing with feed, and also pastures and hay. We break down our budgets where we'll have a separate sheet that'll be listed for what it costs to produce an acre of hay or a ton of hay, and also what it costs to maintain an acre of pasture. And so we're able to credit those costs for those separate enterprises, but it brings them all back into the budget or the herd budget detail. It continues on with the marketing expenses and also on the equipment. So again, it gives a really good detailed scenario to play out, especially if, when you're first starting out. You kind of look at where those costs come into play and how they get separated out and put into a budget. So again, here's just a sheet a typical budget that we have. At the top, we look at the revenue side, and as I mentioned, we break it down per cow. So across the top, we have the unit, whether it be pound or ton or acre, and then the quantity, which would be either pounds or bushels, and then the price per each of those units, and then the price per cow or the revenue per cow. So when we look at call cows, those that are sold, there's a percentage that gets put back onto each cow. So you sell those calls, and then there'll be a percentage that comes back. So in this case, it's $96 per cow. The heifer calves, now some of those are going to be retained for your herd, so you won't have as many heifer calves to sell as with steers. But again, a percentage, maybe around 20% of that calf crop is heifer calves that are sold. And on the steer side, probably around maybe 44%. So again, it gets broke down not on a herd basis, value to individual cow. So you can see here in this example, it's $622 in revenue coming back. Moving down, we have their variable expenses. Again, how I mentioned with the pasture production, hay production, we got it by acre. And in that second column under price, that would be per acre as far as what it costs to maintain that pasture or produce that hay. And that, again, it is then based or multiplied times the acre for pastures or the amount of hay that that cow will consume over the course of the year. Same thing with purchase feeds or supplements and veterinary expenses. On the last line under variable expenses, you'll see labor. This is where your opportunity cost for the value of the labor that you put on that farm comes into play. Now it shows up there at 8 hours at $10 an hour, $80. Now a lot of budgets probably won't put that opportunity cost for labor in, but we feel it's important to kind of show that there's a cost, there's a value within your own time. And if you're comparing, say, a cow-calf operation to maybe raising crops, and if you devoted more time to crops, maybe that returns would be better. Maybe you don't need to be doing the cow-calf operation. Again, it depends on the returns that you have and also how it complements with your whole farm operation. So we also have, down below, we have interest, and we also have marketing, and if there's any land rent, the fixed expenses. Now these, if you kind of look at them a little bit more detail, they seem quite high, but again, we're including everything. And in this example with the livestock enterprise, we're only talking about a 50 cow herd, and we're including all the equipment like the bush hog to trim the pastures, the pasture sprayers, the mower for the hay, and the round baler. So we have all those costs in. So in a true farm setting for, say, maybe only a 50 cow herd, you wouldn't have those high of fixed expenses. But again, we have the tabs that you can go back to and look at and kind of analyze and put your own equipment in, the value, and it will determine the cost coming back per each animal. One thing with enterprise budgets, as far as machinery, it's kind of difficult to and say a barn or sheds, those type of thing, how do you determine what kind of costs that you have or should associate within each enterprise budget? There's a couple of different ways you can do it. One way is I'll show you in a minute as far as an example that we could probably use. Machinery costs, they're anywhere from 25 to 40% of your operation, especially on the crop side. On the livestock side, you could probably get by with a little bit less than that, depending on the scope of your total farm operation. They'll be the same when you're developing machinery costs. It's quite the same as with livestock or with crops. You're going to have your variable cost. Again, those are going to be like your fuel, oil, routine maintenance that you'll have on it, and repairs. And also on the fixed cost side, it's going to be a cost paid whether you use that machinery or not, like interest, insurance, taxes, and housing. And also depreciation is both variable and fixed cost that needs to be incorporated as well. Now, there's a number of different resources available for kind of determining or estimating machinery cost. Iowa State has a really good publication that'll help you determine what you should be charging your operation. For instance, the machinery expense to put in an acre of corn or harvesting hay. What type of machinery cost should be associated with, and they have formulas in place that are a really good tool to walk through. The same thing here with University of Minnesota also has a good resources for machinery management. Now, as far as custom rates, I've been asked that a number of times as far as, how do you use custom rates? Can you just use a custom rate for your farm operation to determine cost? Now, one thing with custom rates, it's not really a good indication of what it's truly costing you to run your own machinery. Typically, if you look at these different custom rates, Kentucky will have a publication on it. I know Missouri, Minnesota, Iowa will also have different rates published, but oftentimes they're too low as far as what it costs for your own operation or your own equipment, because a custom operator, they can run over more acres. They can spread that cost over greater volumes, so they can charge a lower rate than what it actually costs you to your own equipment. Now, Kansas State developed a formula with custom I would say equate custom rates to your own operation. And with that, a lot of times what they'll do is it'll be a percentage. For instance, it may be a formula of like 1.24 or 1.25 that you multiply by a published custom rate to equal what your machinery costs need to be. Now, it's not a perfect formula, but I think it's one of those ways that will help operations get a better handle as the true cost of owning machinery that are used in the production practices. And on smaller operations, a lot of times it's cheaper to maybe buy some of your inputs like hay or corn or some of your feeds than it is to raise them yourself. And this will give you a good idea going forward as far as where that kind of falls into line. Now, as far as with custom rates, they vary greatly. Now, if you have your own operation, you don't have your equipment, but you want to, say, hire a custom operator, it varies greatly. And what I've found a lot of times is people that are doing custom, say, harvesting, whether it's baling hay or maybe using a bush hog to clip pastures, those with smaller equipment actually charge more per acre. And that kind of falls into play that it takes them more time to cover X amount of acres than it would be someone with larger equipment. And it can range greatly, again, depending on your area of the country or even within a county. I would suggest, visiting with your local extension service as far as finding what is kind of the norm in the area. And so again, when you don't have your own equipment, you're relying on others. So that's another thing to kind of keep in mind, that it's not going to be perfect timing as far as when they get your hay cut or your fields planted. However, it does, with machinery costs, especially on the repair side and fuel cost, when you own your own machinery, it's keeping up with the records. It's really critical. It's getting as detailed as possible. Over time, it becomes a benchmark source, so you can look at 1 year to the next and see how you can compare. Prorating in some of these other costs, and what I mean by prorating, if you establish a pasture, you move to a new location, or you want to revitalize a pasture as far as tilling it, putting seed, fertilizer on, that initial cost is going to be quite high. For a pasture, it could be $120 or $100 an acre. For doing a hay field, it could be over $200 an acre. So when you do that, you don't want to put all that cost into 1 year, because that doesn't really reflect the true value of that enterprise. What you want to do is separate that out and prorate it over the life of that pasture or that hay field. Typically on pastures and hay fields, we use anywhere from maybe 4 to 6 acres of life before we have to revisit that and reestablish it. So if your normal cost of a pasture, for instance, is $25 a year with fertilizer and maybe some herbicide treatment, you would have a cost of $25, and then we'd prorate that. For instance, if it's like $120 to establish, we just divide that by 4 for the life of that pasture, and $30. So again, it's not all put into 1 year, the total cost, but spread out over a course of 4 or 5 years to get the true value of that enterprise. Some of the other costs to think about as far as storage and transportation and marketing, these can be quite large for vegetable or fruit production. The storage part of it, marketing, if you're spending time at a farmer's market or doing online marketing, you got to think about that time that you spend devoted to that, and also the cost to use those services. Those, again, need to be kind of determined and added into the budgeting process. Now, the true value, or where it really stands out as far as having a good budget put together for a yield or on a crop or for an animal, is when you come down to a break-even analysis. So when we look at determining what the value is of that bushel of grain or that animal, you'd figure, say, for corn in this example that we're looking at, as far as the yield that you would need, if you know your input costs for planting, all your variable costs, and then harvesting costs, say $600 an acre, and you look out in the futures and you see the price that you feel would be a reasonable guess, say $4 in the fall, or if you store it a little bit longer for that corn, you know that you need to do 150 bushels an acre to break even. Now, with that said, keep in mind that's the break even. You'll have other costs that you'll have to cover. For instance, if you're doing any family living, insurance, those type of things, doctor bills, all those type of expenses are going to have to be covered. So anything above that 150 is going to be more of a profit level that can be used in other areas for family expenses and family living and reinvestment into your operation. On the flip side, when you're looking for that break even, looking for that price that you need to make a profit, on that same principle, if you had $600 an acre for the cost and your typical yield over a course of, say, an average of 3 to 5 years is 150 bushel, you know that that $4 is your break even. This way, when you're looking at a marketing opportunity, you'll know your cost. So if you see an opportunity where it's $4.25 or where you can lock in a price of $4.50 and you're satisfied with that, you do know that you can be making a profit. Where producers run into trouble is when everything's lumped together. You know, they don't have separate enterprise budgets. You know, how do you know if you're making a profit on your corn or livestock or corn or row crop operation? Or is it the livestock operation that's making the money and covering the crops? So by having this, you can kind of look and see which enterprise is truly being a benefit to your operation and which might be and which enterprise may be a detriment. I wanted to just kind of bring up this slide here. Iris put this together for her hemp budget. She did an incredible job putting together a hemp budget for Tennessee. It's really a new enterprise for our state, and we have many people interested in it. And what she did, this is a net return table. So when you look at it, you think back to our enterprise budgets, for instance, for hemp. So all the input costs for labor, for seeds, for fertilization that goes into it will be reflected here on the screen. And what I mean by that is if you look at where it says yield, say if it's 1,400 pounds yield per acre and you get a price of $15, you can see your net return is going to be $6,562. Now, if you go back to that budget and you realize that labor, you're way underestimated and labor is going to cost you more, so you add in extra labor, that $6,500 is going to decrease. It's maybe drop down to whatever is reflected on the labor cost. So as you look through this, the changes that you make on your budget are going to be reflected on the prices that are listed here. You know, everything that's in red is going to be, of course, on a negative. It'd be on the loss side, and then on the black is going to be a positive. So this is a good tool as you're going through putting budgets together to kind of see what kind of effect, say, if you had a shock value as far as decreased production, you know, what kind of returns would you see then? Or price per pound, or even on a crop side per bushel. If that price change, what is it going to look like on a net return? So I would encourage you, if you want to, you know, look up some of these budgets, especially Iris's hemp budget, to give you a good understanding of how it all kind of works together. When we're allocating for overhead costs, and what I mean by overhead costs are some of that get overlooked in an operation. You know, this can be membership dues, it can be insurance, legal fees, accounting fees, utilities and office supplies. You know, those need to be allocated to each enterprise. And the way that we can do that is if you have an income statement over the last few years or Schedule F tax forms, you can track that on your farm records. So on this next slide, this is a Schedule F form on a typical farm. This happens just to be a dairy example. But if you look down on the right-hand side, say line 28, 29, 30, those are going to be some of your other costs that kind of get left behind. So what I suggest with producers is that you do an average, maybe like a 3-year average cost for those, and then allocate that to each individual enterprise. So what you would do is you add those costs up. For instance, if your corn enterprise was 30% of your whole farm budget, then 30% would be allocated to that. If your livestock business was 50%, then you'd allocate 50% of those costs to that enterprise. So again, you know, having those overall good farm records and keeping track of things, you can see how it kind of plays out to when it times becomes to developing those whole farm budgets. One of the last things I wanted to kind of cover is called partial budgeting. Now, partial budgeting it's a tool that's used when you want to make changes to an enterprise. So it's not to develop a whole new enterprise, but just to make changes and see what kind of net returns that you would have. For instance, if you wanted to, say, expand the cow herd or purchase hay versus growing hay, or an example I'm going to show, stockpiling grass in the fall, does that give a positive return or a negative return? So a partial budget will do that. So what we look at what type of added revenue is there by making that change. So if there's any added revenue, you would put that in that top line. That second line is that does it reduce expenses? Is it going to be fewer expenses? If that's so, the second line, then you'd have your total credits. Going further with a partial budget, for instance, if you added fertilizer to a hay crop, you'd put that number in, and does it reduce revenue? It'd probably no, so there'd be nothing there. So what you would do, you would add up all your credits and any debits, and then the difference in that change is what will lead you to that decision. So in this example, in Tennessee, we do a lot of producers stockpile grass, or what we call tall fescue. And what we mean by that is we set aside a certain amount of acres in the fall, and we add fertilizer to it. And we keep the cows off of it for a few months to let that grow up. And then maybe in the month of maybe November, December, January, we let them harvest themselves. And again, that's a way to reduce feeding costs in the wintertime. So with a partial budget, we look at, does it add revenue? In this case, no, because you're not really selling anything, or as far as a hay crop or anything off the cow herd. And as far as reduced expenses, we figure that, by setting aside those 25 acres for a 50 cow herd, we can feed for 30 days on the grass without feeding hay. So we would have a cost savings there of like 17 tons tons, and with a price of $75 a ton, so a cost savings there of about $1,284. Now on the expense side, we set aside that 25 acres and we multiply that out by the extra fertilizer that we put down. So in this case, we'd put 60 units of nitrogen at probably 50 cents a pound. So we'd have a cost of $30 per acre, or $750 for total. So when we look at those net changes, we see that it's a positive about $534. So a partial budget is a tool. If you're just making incremental changes to a budget, it'll kind of help you determine whether that's be a positive return or negative in a planning situation. So kind of in closing, as far as with budgeting, enterprise budgets, I just want to cover, they're the building blocks of that whole farm plan. Having accurate information, having accurate records allows producers to kind of evaluate different farming enterprises. And as I mentioned, when it's all put together, say on a Schedule F form, it really doesn't tell you about what enterprise is making money, what is losing money, where cost savings could be made, where revenues can be improved upon. This way, by breaking it down, you're able to study it further and make changes to your own operations. And again, importantly, use your own input cost and your own revenue estimates. It's not someone else's. This is your farm. This is your operation and your farming practices. And also, allocate overhead. Like I mentioned with the Schedule F and that whole farm budget, don't forget about some of those costs involved, the utilities, just supplies, general supplies, office supplies that you have for your operation. So again, I know we went over a lot of information here this afternoon, and hopefully you gained a little more understanding as far as a farm budget and how they will play into developing your own farm plans. So I just wanted to point out, some of the references that I use and some of the links that can be reviewed by our audience today. So just want to thank you for your time and your attention. And if you have any questions, you can let Iris know, and we'll try to answer them here.
Thank you, Les, for sharing this really important information with us. Budgeting for sure is like any chore that every farmer needs to do. Let's see in the chat box. I don't see anybody ask any questions. I think we got all of them covered. So if there's no questions, we hope everyone to join us next month when we learn about evaluating financial health. And we sincerely appreciate you being with us today. And ask once again, please complete the brief online evaluation, and the link can be found in your email and in the chat box. Okay, we got a question here, Les.
Okay.
Can we get access to the spreadsheets? And how do we get to the links provided in the PowerPoint?
Oh. Now, are you saving this presentation?
Yes. So Stacy, I'm going to upload this presentation right away after this session. But we're going to wait on the videos, and I apologize for that because our tech person is on leave, and we'll upload all the videos once she gets back. All right. I don't think we have any more questions. And thank you all.
All right. Thank you.
Thanks, Les.